Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics. We got action-packed podcast for you. Of course, let's do the introductions. And we have the two co-hosts, my two co-hosts, Cris and Ryan Sweet. Hi, guys.
Hello.
Seems like we've been doing a lot of these podcasts. I think we've been stockpiling podcasts for next week, Christmas week, and New Year's, the week of New Year's, because I don't think we're going to record those 2 weeks. So we've already done those podcasts, and we're this one's going to be released today, though. I think, right? I think it's for today. Yeah, good. Yep. And any words of wisdom, guys, before we move on? Anything Chris point out?
Chris always has words.
Yeah. Always words. I don't know about the wisdom, but definitely looking forward to it. If you are feeling a deficit, certainly I think Ryan and I would be happy to come back next week and jump on the line here.
I really love these podcasts. In fact, I would have no problem coming back next week.
Yeah, they're so much fun. I look forward to it every week.
Yeah.
It is Christmas. It is Christmas Eve.
That's telling, isn't it?
Yeah, we would probably jump on and do a Christmas Eve.
Hey, well, we have a guest today, Ed Goulding. Ed, welcome to Inside Economics. Good to have you. And where are you speaking to us from, Ed? Where are you? Are you in DC?
I'm in DC area, suburban Virginia, Tyson's Corner.
Got it. Ed and I go way back. But I'll have to say I'm a little embarrassed because I get confused. You were at Freddie, weren't you? You were
correct.
Freddie Mac, yeah.
Yeah.
And we got to know each other, it must be 20, 25 years ago now.
Yeah.
I don't know, something like that. And how long were you at Freddie, Ed?
23 years.
I'm sure you know the number of days and hours too.
Some seem longer than others, but yes, the last one's dragged on.
Yeah. And then you went from Freddie to where? Did you go? You didn't go directly to FHA, did you?
Well, as you know, it takes forever to get cleared. So I sat at the Urban Institute for a while. My good friend and our good friend Lori Goodman gave me a seat. So I sat there waiting for the FBI to talk to my neighbors. And once my neighbors gave me the A-OK, I moved over to HUD, first as a senior advisor for Secretary Donovan, and then for head of FHA for Secretary Castro.
Right, and you ran FHA for at least a couple of years, maybe.
Yeah, almost. Well, no, about just shy of 2 years.
Just shy of 2 years.
Yeah.
And what were those 2 years? They were when was that?
Well, again, it was sort of basically March of 2015 to basically noon, January 20th, 2017. Something happened at that point.
Oh, yeah. Oh, that's right. That happened. Yeah. That which we will not talk about happened.
We can talk about it. FHA goes on beyond any administration. It's one of its beauties.
Yeah. And then you came back over to Urban, Housing Finance Center, and you were there for a bit. And I think we might have worked on a paper or two together, I think.
Yes.
And now you're the executive director of the Golub Center at MIT.
Correct.
Yeah. He was the CEO. I'm sure he's still alive. I'm not sure.
No. Ben Golub is the chief risk officer at BlackRock and has been with BlackRock and Larry Fink from really the beginning of the company. As you know, Larry started off as a mortgage trader many years ago before building BlackRock. But so Ben, as being one of the early executives at BlackRock, has done quite well and very graciously endowed an existing center about 7 years ago at MIT. Ben's a double MIT grad, both undergrad and PhD.
Are you an MIT grad too?
No.
You're Princeton. You're Princeton, I believe, right?
Princeton PhD, correct.
Yeah. You act like a Princeton grad. Just saying.
Ooh, those are
No, it's
coming
all
from
good. It's all good. Yeah.
coming from a Quaker.
Yeah.
Oh.
Ooh. Yeah. I was going to ask something. Can you just tell us a little bit about what the center is up to? You know, what kinds of things you're doing there?
Yeah, it's the Center for Finance and Policy. Its mission is to try to get financial policy to be better informed. As you know, MIT is sort of the center of a lot of modern finance. Bob Merton's there as one of our co-directors. And much of the technology and the tools that are used in the private sector haven't found their way into the public sector. And so it's to really inform and to educate both on the regulatory side, but probably more importantly, the government is the largest provider of financial services. Think of Social Security as a retirement service, think of student loans, and really think of the mortgage market is a government, exists because of government policy. So it's important for the government to understand discounting options, and the like in evaluating how to be more effective in the services that they provide. We do annual conferences. We did one on retirement. We did one on housing finance. Our most recent one was on the environment and climate change and the role of financial institutions in that. A little bit of, is it better to divest or engage? What are the different returns? We had a very good discussion, including one that you're probably familiar with from your graduate studies. What's the right social discount rate? What do we do about, future generations are not in the market to express their preferences and views. So how do we struggle as a society to decide how to discount the future on that? So it was a fascinating conference. We even had a geologist remind us that we economists are a little short-sighted of looking at 10-year budgets. He looks at millions of years at a time. So,
hey, this is a bit of a tangent, we'll come back, but on the discount rate, I've got this kind of pet theory that because interest rates are so low and they've been low, it feels like they're going to remain low, that actually makes it more economically viable to consider these longer term costs, like the risks of climate risk. It kind of brings forward, the threat here, and that we should be thinking about this more deeply at this point in time, in particular because of the low rate environment. Does that sound right?
Well, yes. I mean, although one of the speakers said, "Why stop at zero?" I mean, there's just that's sort of an arbitrary. That's an arbitrary number. I think the other consensus that, I don't know if it's a consensus, but another theme that came out is these are difficult social policies. Don't look to the market. Don't look to the Treasury market to answer them. For better or for worse, you need to look at democratic consensus as much as you can look at a market. But it was very, very well-established economists didn't have any answers, which is maybe not too surprising for our profession, but it's a tough one on what to do about a climate change and how to quantify the future costs.
Well, that sounds it. We should definitely have you back for that one, perhaps for another podcast. But this podcast, we are going to focus on housing finance, and your expertise. And as I mentioned, Cris is a houser too. He came from. Did you guys ever run across each other? I think Cris was at Fannie. You were a modeler at Fannie, weren't you? Did you ever run across Cris?
Only by name. I don't
Only by
think we
name.
ever...
Oh, good. I assume.
Absolutely. But there was quite a bit of cross-pollination between the institutions, certainly. So there were definitely ex-Freddie Macers that I worked with, vice versa. So.
Is that another Zandyism? A Hauser?
That was
No.
That's a new one.
No,
to me,
wait.
but-
No,
That goes way back.
Yeah.
Oh, okay. Never heard that.
I should have taken credit for it though, but no.
Should've.
Yeah. Usually
Ed would have called me on that one. Yeah. No, Hauser is, I don't know who coined that term, but that's been around a while. Yeah. For the housing industrial complex, right? I mean, the folks that are in that world. And I say Ed and I've been kind of in that world, right? Wouldn't you say?
Yeah.
Yeah.
Yeah,
Yeah.
but don't forget, housing, as we'll talk, housing goes way back. There are great quotes from Lincoln and FDR about how housing is important to this nation. So being a houser is not a bad thing.
Oh, yeah.
Different than
yeah,
a homer. Right?
Yeah, a homer. Yeah. Right. Well, let's dive into we're going to start with Ed, as we were discussing earlier. We're going to dive into a bit of the economic statistics. We play a bit of a game. Each of us identify a statistic, and the rest of the group tries to figure out what that statistic is. You can questions and clues, that kind of thing. The best statistic is one that's not too easy, so that it's a slam dunk that Ryan will get it, and not too hard that no one gets it, and maybe even one that is relevant to the topic of the day, the big topic, which is housing and housing finance. And you're more than welcome, Ed, to play this game. I know you have many statistics up your sleeve.
I make them up is my problem. But,
fair enough.
They're harder to guess if they're made up. But
all fair and love in statistics. And Ryan likes to throw in one more rule, and that is it has to be a statistic from the last week. But that doesn't apply to you, Ed. That just applies to the rest of us. So
and housing doesn't change that quickly. So
that's a good point. That's a good point. So we're going to begin with Ryan. Ryan, you want to lead the way? What's your statistic for the week?
All right, so I'll give you two numbers. They're
Okay.
related: 1.6% and 2.5%.
And this is a statistic that came out this week, presumably.
It did.
1.6, and you said 2.5.
Correct.
Okay, and is it in the retail sales numbers?
It is not.
Okay, is it in the industrial
Industrial
production numbers? It
No.
is not.
No.
Think-
Oh,
This release, you usually don't associate it with numbers, but once in a
Oh.
while, it comes out with numbers.
oh.
Is it the beige book? No, the beige book didn't come out.
No,
This
that
week.
never has numbers.
No,
Nope.
no.
You're on the right track.
I am on the right track. Something the Fed. Oh, is
Fed
it in the
statement?
FOMC release? Because the Fed met this week and they came out with their statement and their
Getting warmer.
forecast. I'm getting close, right?
You're getting very close.
Okay, say it again. 1.6 and 2.5.
Mm-hmm.
Is it in their forecasts? One of their
It is.
forecasts?
A
It is.
projection, yes.
It's a projection. Oh, Chris, we ought to be. Oh, two. I know. Oh, wait.
Interest
Wait.
rate?
2.5 is the terminal federal funds rate.
Yep. What's the
Terminal
1.6?
meaning, huh?
Okay, go ahead and explain.
Okay, so the terminal funds rate is where the funds rate should land in the long run,
Mhm.
consistent with a full employment economy with inflation at target and the economy growing at its potential. How about that
Exactly.
for
That's perfect.
2.5? Okay, now 1.6. Chris, help me out on this one. Or Ed,
They're
what is
related.
1.6? Oh, is it? They give us a distribution of.
Oh, I wouldn't send you guys down that rabbit hole. All right.
You wouldn't-
So
okay, that would be too far.
1.6 is
no.
what markets expect the terminal Fed funds rate to be.
Ah.
2.5% is what we have and the Fed. So there's a little bit of a disconnect. So-
When you say that, how do you know you're going into futures markets and teasing out where the long run contracts are landing? Is that
Yeah, I mean, you look at the five-year forward nominal treasury yield,
okay?
and right now that's 1.6%.
Oh, I see what you're saying. Oh, I see what you're saying. You take the 10-year yield, you decompose it, you get the real short-term rate, you add in inflation, and you're at 1.6.
Correct.
Oh, wow.
And historically, so it's the whole idea is, I mean, things can change. Like that could move higher, closer to the Fed's target, but this tightening cycle may start sooner than people anticipate, but it might end faster because markets may push back against how high the Fed funds rate can get.
Hey, Ed, do you have a view on all this? On thinking around where rates should be in the long run. This is a key question for housing, obviously. Particularly long-term interest rates. But
I mean, that's why it was a beautiful number.
Yeah, I mean, and the 10-year rate still sticking at around, I don't think it's broken 1.5 yet, has it?
Today it's like down to 1.4 or
Or-
1.3
Yeah.
or something. Yeah.
Yeah, so it's interesting and of course, mortgage rates are keep more off of the 10-year rate. In some sense, either the markets think the pandemic's going to last forever, I hope not, or it goes back to sort of the fundamental demographics that there's going to be more savings than investment globally.
Right. Right. Hey, one thing though that maybe also be playing a role is all the QE, right? I mean, the balance sheet, the Fed's balance sheet is so bloated at this point. And it's not only the Fed, every central bank on the planet is larded up on sovereign debt. And that has to be taking a big chunk out of long-term interest rates, right, Ryan?
Yeah, I mean, when you decompose it, you look at the term premium, and that's where QE, quantitative easing, mostly affects long-term rates. It's still negative, and it's actually over the last couple of weeks fallen even further.
Yeah.
So
Right. So do you have a kind of a rule of thumb, translating the size of the Federal Reserve's balance sheet, the amount of quantitative easing they've done, and what it means for long-term rates? Have you thought about that? I used to have a rule of thumb. I can't quite remember. Well, I think it was like for every percent, QE as a percent of GDP, for every percentage point of GDP, it was like four basis points, something like that.
that sounds right.
Okay. So if you do the arithmetic if you go back before the pandemic and look at the balance sheet as a percent of GDP and look at it today, I think it's up about 15 percentage points, right? Something like that.
Correct.
And so you take 15 times 4, that's 0.6 percentage points. So instead of, let's say, 1.4% today, if the Fed had not QE'd and not bought bonds, but not expanded its balance sheet, the long-term yield, all else being equal, would be 2%.
2, right?
Yeah, 2%.
I mean, the first few rounds of QE after the financial crisis, when you add it all up, reduced long-term rates by 100 basis points.
Say that
So,
again?
After the Great Recession,
Yeah.
those 3-4 rounds of QE that the Fed did, including
Yeah.
Operation Twist, reduced the 10-year Treasury yield by 100 basis points.
Or full percentage points for folks
Or
that don't know basis points. Okay. So it's consequential, significant. One other quick question about that. I know I'm going down a lot of rabbit holes, but just I'm curious because it bugs me. Do you think because of the Fed's QE and the impact we just articulated for long-term rates, that it's messing with our ability to glean inflation expectations from 10-year yields? That maybe what we think we know, we don't really know because everything's all messed up by the Fed's QE?
Yeah, I mean, it's particularly messing up TIPS, so Treasury Inflation Protected Securities. So the Fed's been buying a boatload of these things, and we use that to calculate market-based measures of inflation expectations. So I do think it's distorting it a little bit, but you can go and look at other measures of inflation expectations that are not being affected by the Fed. So inflation swaps, and everything suggests that markets think, inflation is transitory and we'll get back to 2% at some point.
Okay, so what you're saying is even though there's these distortions created by the Fed's bond buying, its quantitative easing, even abstracting from those biases that result, investors are still saying inflation's coming back down. Okay.
Yes. Yep.
All right.
The surveys say similar things as well, right?
Which surveys?
Consumer surveys, economist surveys, business leader surveys, they all suggest the same.
Right. Okay.
Interestingly, they did that those surveys by age of the respondent.
Yeah.
And us oldies who remember the inflation were much higher than the people who have never seen inflation. It was, I think, a good percentage or point or more difference between, broken out by age of respondent.
That is really cool. I didn't know. Where do you see that data, Ed?
The New York Fed, I believe.
New York Fed.
I read it in the Wall Street Journal, but I didn't. Yeah, the source.
Yeah, it's New York
That is
Fed.
really cool. That's interesting. So people's inflation expectations are conditioned on what they've lived through. I guess that makes sense. But yeah, really, wow.
And you can probably argue that some people's inflation forecasts are also based on their experiences.
Are you referring to me, Mr. Sweet, or
No, I'm saying the three of us. Like,
Okay.
remember, we go back to our inflation forecast. Like, you're higher than I am, and Chris is right
That's
in the
right.
middle.
I'm
I
on the high
wonder-
side of you guys. You're on the low
Yeah,
side.
Yeah,
And
because
I'm
you
the old guy and you're the young guy. That's
Well, no,
right.
I'm not saying that. I'm just saying you
Oh.
you lived through an
You just
inflation
implied it.
period.
The
And I've never
regression,
experienced inflation, so
you have the regression of age and
Yes.
good fit
That
with 3
is
points.
Interesting. That is interesting. I'm gonna have to go take a look at that data. Okay, Mr. Dorites, you're up. What's your
All right,
stati-
152,000.
I know what it is. Ding, 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 ding,
Oh,
ding, ding,
geez.
ding.
oh no.
You
Where's
know
the
why
countdown?
I know this, Ed? Because he keeps going to the same well every single feels like week.
No, this is topical.
This
Goes
Oh.
right
This
to
is
the heart
housing.
of.
This is housing. 100. It's a good statistic, though. Ryan,
It
you
is.
don't know this statistic?
All right, let me give you the corollary.
No, no, no.
752,000.
What corollary?
752,000 related.
Ding, 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 ding,
All
ding.
right,
ding,
let
ding,
Mark
ding.
do
I
it.
know
All
the
Go
answer to
ahead.
that
All
one
right.
too.
All right, go for it.
Actually, you know why
Oh.
I know all this? Because those were my statistics, Dorites. You took
You're-
my number.
We're right.
All right,
We're on the
Ryan,
same
do you know these
wavelength.
numbers? I can't believe
No.
Let's
these-
let's
Ed?
keep digging into the bowels a little bit of the report of the housing starts report.
Oh, you're
You
going.
can't just give me
All
the
right.
top
No,
line.
this is
right?
this is important. These are important
is-
statistics,
yeah,
actually.
I agree.
Yeah, I give Chris credit for this because I was going down this road, which makes me now I got to come up with another statistic. Oh no. Okay, I can do it. All right.
Back to normal.
We
index.
know. Yeah.
Okay, all right.
95.2.
750. That is the number of homes that are under construction. And
Single family.
is it just single? Yeah, single family homes under construction, and that's the highest level since I think March of 2007, I believe. Is that right, Chris? Yeah.
Yes, that's
Highest
right.
level
That's right. Yep.
You guys got to be impressed with this. No.
Yeah.
Ed,
No,
are
I
you
am. I'm impressed.
Ed is thinking. Ed. Chris told me this is what he was going to ask. That's how impressed Ed is. I could.
I am impressed.
Mhm.
152K. That is. That's also interesting. That's the number of homes that have been authorized to build, but haven't even started. And that also is that a record high or pretty close to a record high, Chris? I don't know.
That's the highest since 2006.
Oh, it is. Okay. So, you add those two numbers together, that's a lot of housing out there that's going to come to,
Yeah.
partly it's because, well, you explain what's going on here, Chris. That's your statistic. So what's the significance of these numbers?
Yeah. So the 152,000. That's the other important point about that is up 41% on a year-over-year basis, right? And it points directly to the supply chain issues, right? So builders are certainly interested in building. They see plenty of opportunity. They're getting the permits and they are, starting where they can, but they have a boatload of homes that, again, have been authorized but not started. They're kind of in reserve. They're waiting for workers or other supply chain issues to resolve themselves, and it just points to the backlog that they're facing. So they're not able to actually put up all the homes that they actually would want to, given this current environment.
Yep. Good statistic. Very
That was a good one.
That was a good one, right?
Yep.
A very good one.
See?
Yeah.
All right.
So Ed, are
You're
you gonna play
learning.
this game? You want to play the game?
Yeah,
All
So
right. Fire.
mine
Okay,
are
great.
not this week, but mine are November, since, as I said, a lot of housing data is quarterly, if not on that. But I'm going to give you four numbers in descending order.
Okay.
74.0%, 60.2%, 48.3%, and 44.0%.
I know this. I think I know.
Were you guys
Fine.
emailing?
No. I
There-
think I know
there
this.
is no
Okay.
way
Yeah,
those four
that's-
numbers just
I
rattle
know
off.
this.
No.
I know these numbers. Yeah. Unless I could be wrong.
There are pretty obvious ones if this is what you follow. But yeah,
Yeah.
Chris, Ryan.
Chris should know this. If Chris doesn't look, he's looking. He's Googling. He's Googling.
No,
I
no,
can see
I'm
him. He's
just
looking
writing.
down. He's Googling.
I wrote them down. So.
Oh yeah. Okay. You want me to
See,
go?
what's throwing me off is
They're all-
you said quarterly, so
Yeah,
that rules
quarterly.
out an AHB. So quarterly.
I think they're
Home ownership
quarterly.
rates. I'm going to put you out of your
By
mind.
age, right?
Home ownership rates by racial ethnicity, right?
Households.
75 is like white. What
70
62 is what? Ed? What?
60.2 is Asian American,
Oh, Asian Americans. And then Hispanic is,
8.3,
and
yes.
then the black homeownership rate is obviously
Yeah.
very low.
Right. And then I actually, very quickly, I'll add three numbers that were not in the release, but to show that I can multiply. If you turn those into households, what each group would be if they had the same homeownership rate as whites, you would have 5.2 million additional Black households, 4.7 million additional Hispanic households, and 1.0 million more Asian American households owning houses. So you better start building more than 173,000 units if we're going to
Yeah.
close those
Wow.
gaps.
Hey, if we don't make any as a nation progress in improving home ownership for minority groups, for Black, Hispanic, Asian Americans, the home ownership rate is going to decline pretty significantly here, isn't it? Because the share of the population that is minority is going to is rising pretty rapidly, particularly the
Yeah.
Hispanic share, and that's going to continue to rise. So home ownership is going to fall pretty dramatically if we don't make some progress, I would think. Or is there
Yeah.
am I thinking about that right?
Well, I mean, yeah, I think that is right. I think, and of course, the Joint Center on Housing Studies up at Harvard, has done those types of projections, and sort of broken it down by again age, vintage, and when the households are coming on. But yes, you'll see a drop in the overall home ownership rate if we don't change that mix.
Does it surprise you, Ed, that and I know we're getting a little bit into the big topic, but since we're kind of here, that we, when I say we, the collective we, have not seen any improvement in home ownership, and really since I think soon after the Great Depression, there was a big increase in home ownership, obviously because of all the policy changes. Fannie was put on the planet. FHA was put on the planet. There was a lot of policy put in place to promote home ownership, and it worked. But really, since I'm speaking from memory, so I may not have it exactly right, but really since the 60s, 70s, we really haven't made much progress.
Yeah. That's right. The Black home ownership rates went down to what they were in 1968.
Right. So does that go to policy, or what is that? What do you? I mean, Fannie and Freddie were put on the planet to promote homeownership, most fundamentally, right? I mean,
well, in some sense, even today, it is the FHA, and VA programs that are the gateway to first-time home ownership. Freddie and Fannie do great things, but it's not their basic product. Where with FHA, it's 80% of what they do, 80 to 90% are first-time home buyers. FHA's been around a long time. A lot of this comes back to questions of how the bottom quintile has the bottom two quintiles have done in terms of income and growth, and really their wages have not kept up. And that's where you'd expect to be the margin to be, where if you're going to increase the home ownership rate, it's people in the bottom two quintiles who have to make the leap to home ownership.
So what you seem to be suggesting is it's not housing policy per se that's failed. It's just broadly the inability of our society and economy to lift up the financial fortunes of folks that are renting.
Yeah, I mean, we can. It's one of those things. If you're trying to get those four numbers that I just the numbers I just gave you represent 10 million households. You have to look at all levers. We can talk about this. The mortgage market can do a few things that it hasn't done, but it's not financing. That is it to a large extent are questions of income and supply of we need to build more supply of affordable houses on that. And traditionally, a lot of these cities, you would build at the high end and you would see filtering down to the lower end of affordability. There's been some studies to say that filtering process has slowed down considerably. So it's difficult to find affordable housing in a lot of communities.
Got it. Cris, do you have a perspective on this? I mean, in terms of the lack of progress in the last 50 years on home ownership, what you have any perspective on that?
I agree. We need to identify the root causes. I don't see that it's financing, right? And Fannie and Freddie, their mission is liquidity, first of all right? Keep the mortgage market operating, make sure that there's ample liquidity in all environments, right? They don't control the levers in terms of supply. Neither does FHA really either, right? So, and that I view as the real factor here. And in addition to certainly incomes and the ability of folks to pay the supply is outside the purview of the federal government. It's much more in the purview of local governments in terms of zoning and where we choose to locate housing or permit housing to be built.
Right. Okay. Well, let's come back to housing. You guys want one more statistic to round this out? I'm going to mix it up a little bit, just to mix it up. 16.5%. 16.5%.
All right, so I guess this is non-housing related.
Yeah, non-housing related.
Okay.
And it is from this week.
Indeed, it is.
Probably not. Oh, it is. Oh,
It is.
Indeed,
Okay.
it is.
All right.
we go in retail sales, something in the.
On retail sales.
Okay. All right. Let me think about that.
Yeah.
Is it year over year
Uh,
number?
It is
Building-
year over year. Yeah. Very
Building
good.
materials.
What is it?
Building materials.
No, I
Whole-
would consider that to be a little over the top to go that deep into the.
Are you doing control retail sales year over year?
Close. Yeah, control meaning X auto, X gas, X building materials, right?
And X restaurants. So a lot of
X
X's.
restaurants,
Yeah.
right? Yeah. No, I didn't quite go there, but you're close.
Non-auto?
Non-auto, non-gas. So
Okay.
retail sale. This is year over year percent growth in retail sales, excluding autos and gasoline. So kind of my proxy for for Christmas sales, holiday sales. So, but this is through November. This is through November. So we need one more, of course, data point for December. But it could be a disaster in the year-over-year increase in holiday sales. So that would be retail sales, X auto, X gas, November and December this year compared to last year is going to be well into the double digits. Again, even if December is a wipeout, that bad.
And it shouldn't be.
Huh? And
It shouldn't be.
Right? It should
No.
not be. Right.
No.
Right. We're already halfway through, so hard to imagine that would be. Obviously some of that's inflation. Clearly retail goods prices are up a lot, and I'd say maybe 7, 8, 9% might be retail because CPI is up almost 7% year over year, so it's probably higher for goods. So that still leaves you real growth of close to double digit, right? Right? I mean,
Yeah.
This could be the best if you measure Christmas sales by that measure. This could end up being the best Christmas on record, I think. Just amazing. So all the hand wringing, all the gloom and doom, everyone's really feels like everyone's so pessimistic. The economy's chugging, right? At least up till now. Now it could change with Omicron and Delta. Obviously, another wave's coming here pretty fast, and we'll see how that plays out. But feels like the economy's pretty strong.
Yeah, it's going to be strong this quarter.
Yeah,
I'm worried about early next year as this
early
wave.
next year.
Yeah.
Yeah.
'Cause if you look at case counts, look at Chester County. We're almost higher than, that's where we're located, is almost higher than it was at any point throughout this entire pandemic. And that's just in a few weeks.
No, that's true. Hey, are you guys, another thing that confuses me, and then we're going to dive into housing, is if you look at the economic statistics, I mentioned the holiday sales, but many others as well, the economy feels strong, feels like it's growing strongly. Yet consumer sentiment surveys are very, very weak. The University of Michigan survey is at a low point in the entire pandemic. How do you square that circle? What's going on there? Do you have a view on that? Anyone have a
gas,
view?
gas prices and
Gas
the
prices.
pandemic.
And the pandemic.
hmm Especially for UMich, that's very sensitive to gas fluctuations in gasoline prices.
The University of Michigan survey.
Mhm.
Yeah. What do you think, Ed?
I-
Do you find it, is this gotten on your radar screen? Is this something you've thought about?
Not much. This clearly, it is inflation is at points can be shocking to people who haven't experienced it. And then, of course, as we know, wages, sort of keep up, sort of don't. And I think it adds to the volatility for the consumer. Um, if they don't expect their wages to climb, or if you have savings, right? If you had your money, a senior who had his money or her money in a savings account, all of a sudden has 10% less money than they had a year ago. Not quite, but I think there's people are trying to grapple with what inflation might mean to them. So I wouldn't discount, I mean, gasoline is one of it, but it's not the only element that's experiencing inflation. Rents are way up in many areas. And I think, as you know, how we put housing into the CPI is rudimentary at best, especially the owner-occupied stock. So what's happening to those numbers, both the headline numbers and then the gas pump, the grocery store, and the like, I think it's very concerning to people.
Yeah. And what you're referring to on the rent is, if you actually look at the rent increases that people are seeing for new move-ins, for people who are
Right.
actually starting to rent, it's like, I don't know, it's like 15, 20%
Right.
increase over last year. But that's not what's showing up in the consumer price index because of the way the Bureau of Labor Statistics, the keeper of the data, translates the rent increases into what it means for, CPI rent.
Right, it's that owner-occupied 2/3 that gets it gets in there, but it gets in there probably with a lot of noise and a lot of lags.
A lot of lags. Yeah, right. Chris, do you have any view on that? On the
On the
seeming
sentiment?
disconnect between sales, what consumers are saying, and what they're doing?
Yeah, I'm increasingly concerned about measurement errors in the surveys and so in terms of who
Oh,
responds to the survey and how they respond. If you look at the University of Michigan, they have a breakout by political party.
Mhm.
There's such a gap between the Democrats and on current economic conditions, let alone your views on future economic conditions. But it's so closely tied to who's in the White House. It switches like the day after an election, right? So I don't know how credible that is in terms of a true measure of sentiment, right? It's in terms of the soft data. You look at the hard data, which is how people are actually spending it. I
Mhm.
think that's where the rubber hits the road.
Yeah, that's why I always watch what consumers do, not what they say.
Yeah.
Although there are times when what they say is important, right? Turning
Inflection
in the
points, yep.
economy.
Sure.
Yeah.
Yep.
right.
But I don't think we're at an inflection
That's
point
not
right now.
typical. Yeah. Okay.
Yeah.
All right.
That was
Very good.
Mark. You had a strong showing.
I know.
That was good.
I was waiting for someone to say that. Yeah,
I know.
I'll take it. I had a strong showing this week. This
That
is
was very
episode,
strong.
whatever it
Cowbell.
is, 38. We need to mark it down.
Oh, yeah,
Put a little
we'll give you
sign next to it.
your cowbell there.
Here you go. I
All
get my
right.
cowbell ring.
See, now we have to have an episode next week because we can't let Mark
And the
Yeah.
year.
end the
Yeah,
year
'cause
like
we're not
this because
recording
we're
it.
not going to hear it, the end of it, until next year.
I had a strong showing, baby. All right, let's turn to housing more formally, and I think there's a lot of things to focus on, but I think the thing that is now clearly the most significant pressing issue is supply, right? The lack of supply. Would you agree with that, Ed? Is that fair in the top of list of things to be worried about in housing? It would be supply.
Yeah, I mean, partly, there's always the question, prices are, up almost 20%. The question I always get asked is it a bubble?
Oh,
And, I go back to, our economics 101 days. There's the alternative to a bubble is just an old cobweb model. I don't know if you remember the cobwebs.
oh, sure. We talk about
Um,
that all the time on
yeah.
Inside Economics.
Yeah.
This is a record.
Ah.
Twice the cobweb model has come up.
Oh, okay.
Yeah.
But, in some sense, it doesn't feel like a bubble. It's if you look at prices of houses versus rents We just talked about rents going way up. So if rents go up, you would expect the asset value to go up or prices to go up. The amount of flipping, speculation, irrational exuberance, there's some there, but not a lot. And the alternative is we've just underbuilt. People have estimated, pick your number, 3 to 5 million units over the last decade that should have been built in terms of housing formation and potential housing formation. That we need about 3 million to 5 million more units. And unfortunately, even the tornadoes that we experienced this last week reminds us that there's a good, several 100,000 units a year get destroyed through fires and natural disasters and just sort of depreciation. So we've been sort of underbuilding, and it clearly, we expect to see a supply response. It seems like it's going to take a long time for that supply response to be so great as to bring prices way down. People expect a slowing of prices with that increased supply, but I don't think anyone that I know of is forecasting prices to drop, that we still need to work through, a good deal of supply.
So what you're saying is, obviously house prices have been rising very rapidly. Depending on the index, the house price index you look at, it's up 15, 20% year over year nationwide. That's nationwide. But there's good fundamental reasons for that. Most significantly being we got a severe shortage of just homes. There's just more people out there looking for homes than there are actual homes. And that it's not a bubble, prices are up, not a bubble because you have this fundamental supply side support, but also you just don't see the kind of traditional characteristics of a bubble flipping you mentioned, which is I buy with the intent of selling quickly at a profit. Back in the financial bubble, the financial crisis, the housing bubble, which was, I think we all concur, is a bubble. You had a lot of people, a lot of flippers, and they were using debt, borrowing money to finance the purchase to leverage up, and you don't see that today, is what you're saying. So it's not a bubble. Cris, do you concur with that view? Is that your perspective too? Do you buy into that?
I do.
Would you push back on any element of that?
No, I guess the only caveat I would throw in there is the time horizon. I don't see a bubble certainly right now. I think the factors are there, right? A big demographic wave with the millennials coming in, right? So it's actually justifying additional building and certainly the additional demand. That's different than the financial crisis where we actually had the reverse. We had that smaller Gen X generation coming through, which actually exacerbated the issue. But I do get worried as I look 5, 10, 20, 30 and beyond, because that wave will pass through. The next generation is smaller, and the baby boomers are going to be downsizing at that point. So there's going to be more supply, less demand at that point. So I wonder if that does also factor into the minds of builders as they're thinking about their investment decisions. Yeah, times are good now. I want to certainly meet the market, but I'd like that wave to continue. I'm going to extend that as long as possible versus a boom and bust type of cycle. So
really, I don't know. I think you're giving builders way too much credit. Oh, maybe I'm wrong.
Well, given the experience they went through, right?
The publicly traded builders, which are now a larger share of the home building market, they're probably more disciplined. Yeah, for sure.
I think so. Yeah.
Huh.
I think first order is just their capacity constraints.
Capacity.
Right? So you're right. Yeah, for sure. Yeah. But maybe in the back of their mind, they're also thinking, I'm not going to overpay. I'm not going to, really ramp up the capacity, do everything I possibly could because, better to let the cycle.
Well, it's also better to have bigger margins. I mean,
exactly.
They're not. It is the competition that will eventually come in, and the big immigration policy is sort of always lingering in a variety of ways. First and foremost, household formation is very dependent on immigration, and second, a lot of the skilled labor comes from many of the recent immigrants too. So lots of uncertainty there.
Yeah, we also put together these. Well, recently we've been, because we get the actual housing transactions, and we can see, who the owner is and how quickly they hold on to the property. And we have seen a significant increase in the investor share, investor defined as a corporate owner of the property. But it turns out that it's mostly long-term institutional investors, the folks that are buying property to rent the property, so buy and rent. And that's become a very popular kind of business model, since the financial crisis, and that's come onto the fore. So the actual flipping, those would be people who buy, and then we can see this, sell the property. It's an arm's length transaction, at least within 1 year of their purchase. That remains low, right, Chris? We haven't seen any real pickup there. Yeah,
that's right.
There are some markets it's starting to pick up, like some of the real juiced markets, like a Phoenix, for example. I think we've seen some increase, but
some of that. There are also some oddball or markets you wouldn't think of as having some of that activity, as people perhaps are working remotely and looking for deals in second tier, cheaper cities. But yeah, by and large, we don't see speculative behavior across the board.
Yeah. Hey, Ed, you said one thing I want to probe a little bit more deeply about no price declines. No one's forecasting price declines. One thought I had was that one reason why we're seeing the surge in prices is that mortgage rates have come down in the pandemic. The 30-year fix is going for 3% ish, which is about as low as it's ever been in history. And that juices up demand, right? Because, people can get a home with a low mortgage rate. That bumps up against the lack of supply, and that just causes prices to go skyward.
Yeah.
So if you buy into that kind of narrative, then if mortgage rates rise, and it feels like they ought to rise at some point, but who the hell knows when, but they ought to rise, that's going to suck the energy out of the market pretty fast. That affordability, the higher mortgage rates conflate with the higher house prices, affordability gets crushed, demand gets nailed, and we actually could see some price declines. Does that resonate with you, that kind of thought?
Well, there's always a question. Some of this goes back to the question of the underlying inflation. Do we see real declines versus nominal declines? So keep that,
Okay. Yeah.
just put that on the aside for a moment. It's obviously it'll dampen demand, although rents, a lot of these decisions are not purely based on interest rates. Future expectations become an important part. And then just people really want to live certain places where they want to buy a house. They want the extra bedrooms that rental won't always afford them. I don't see it happening with the 50 basis points increases or even the 100 basis points being a major effect. When mortgage rates went to back 1981, when Volcker stepped on the brakes or slammed on the brakes, and mortgage rates were at 12-13%. Of course, that would be a big dampening and could drive prices down. But if mortgage rates are 4%, 4.5% instead of 3%, don't see a big effect out there.
Let me ask you this. Okay. You come back a year from now. A year from now, mortgage rates are still 3%-ish, maybe up a little bit. House prices have risen another 15 to 20% nationwide. Would you be saying the same thing, do you think, as you're saying today?
Well, that's always at some, I think, Chris,
all else being equal.
This is always I'd worry about it being a bubble at that point. Yes.
At that point. Okay. All right. Yeah.
If you look at the FHFA's capital requirements, they have a long-term trend. They adjust LTV for the long-term trend. Many of us, I think maybe even you, have written on that's not a great way of locking in what you want to accomplish in terms of controlling capital. You just sort of put it on automatic pilot. There, the Fed and the whole Basel arrangement allows for people to FSOC to do capital countercyclical adjustments, but the FHFA rule puts it on automatic pilot. I think last I checked, and this is a quarter ago in terms of their adjustments, so before the latest increases, they thought we were about 16% above long-term real averages.
Yeah.
They give you a corridor of 5%, so they adjust all the LTVs by 11%, I think was the number. At that point, again, instead of 11% above the corridor, what you hypothesized would be, more than 20% outside that corridor of long-term trends. We haven't seen that before. That would be worrisome.
Yep. You said a boatload. I know, Chris, you've been using my term boat. That boatload is that's a Zandyism. But you really said a lot there. There's a lot to unpack. And I'm not going to attempt to do that, except to say that what you're saying is FHFA, the regulator of Fannie Mae, Freddie Mac, has capital standards for those institutions. As part of setting those standards, they try to account for whether housing markets are richly valued, overvalued, and certainly if they're a bubble. They want to say, hey, Fannie, Freddie, these markets feel really hot, sizzling, overvalued, there's froth. We think you need to hold more capital against that. So that's the principle here. And what you're saying is, in that calculation, they're coming up with at the current point in time, based on the FHFA house price series, which is actually obviously just for Fannie and Freddie loans, not the entire market, that it's overvalued by about 15%.
Right.
And by the way, Chris, correct me if I'm wrong, that's based on our modeling that we've recently been doing. That's where we're landing, about 15%.
That's right.
And what that means though, Ed, that's nationwide. That means that you got a lot of markets out there that are overvalued by a lot more than that, by 25, 30, 35%. So, I think the market is actually quite vulnerable, if rates rise even a little bit, I suspect. Not nationwide. Here's the other thing about house prices that people forget is important. It's measured house prices, right? Because what happens is, if markets go weak, people just pull the home off the market. They're not going to sell their home. They got, everyone's seeing these house prices today. Like I look at Zillow for this home in Pennsylvania, and I'm going, oh my gosh, that's how much this is worth. And it's going to take me a lot to sell my home for less than that anytime in the near future, because that's my so-called reservation price. Yeah. So if I don't have to sell, I'm not going to sell. So what you see is transactions come off. You don't see actual sales, and you don't measure it in prices. So you might not see the price declines because the so-called shadow price might decline, but not the actual price. Anyway, so let's now go back to supply, because, this is key to, a lot of what we just talked about in terms of house prices, but also in terms of, what's going on in terms of people's lives. They're paying more in rent, single family housing less affordable. They have to move further out from wherever their job, go farther away from their job. It's not good for, commutes and the environment. It's not good for the macro economy. Lots of problems with the lack of supply. And there's a lot of debate and discussion around this. And I'm sure you have a long list of the reasons why supply has been so constrained, but what would you put at the top of the list of reasons in your mind, Ed?
Yeah, it goes back, I think, to local policy. At the end of the day, we don't want the density. We come up with ingenious reasons why density is not good for whatever. And so I think that's a large part of it. I'll go back to you go down the list, but just in broad categories. Our transportation policy doesn't, we get just more congested, very hard to build a dense subway system the way New York has, and the like. It would be much easier to build density if you had the transportation. And then so the other big category is education. The way we fund our schools are very tied to the tax base and and the like. We don't tie it to general economic well-being of the the larger area. We tie it to the house prices of that community and the number of units. So it's like a per capita type thing. So education policy, transportation policy, and then just sort of general, which then shows itself in our zoning policy and permitting policy. Very hard to get the permits
Right.
on that. Yeah, so that's where it is. And then of course, lumber and labor's got more expensive in this area. We don't invest in the building trades the way we used to. So it's just more difficult. There was always the hope that 3D printing was going to drive down costs. I was always a little bit of a skeptical on that. But it's we're seeing more stuff manufactured, trusses and the like, in factories, but the cost has not come down with technology on that. So we haven't seen the technological improvement that you would have hoped to see either. So, and that's also largely policy driven. So it's I'm up at MIT. They keep on having all sorts of nifty things in their laboratories. Maybe one day we'll find a house that grows itself, and we'll solve it right after we get nuclear fusion and don't have to worry about energy costs. But so technology may get us there, but so far we outside of TikTok, we really haven't seen things that have affected this market the way it would be nice if we could.
Yeah. So at the top, there's a long list of reasons why supply has been lacking. At the top of the list is restrictions on development, zoning issues, and other, which I don't know. It seems like that's a pretty tough one to tackle, right? I mean, politically, I don't know how you do that because the federal government really doesn't have a whole lot they can do here. Although they can use sticks, but politically, using sticks to change zoning laws would be pretty tough, I think. I wouldn't count on it. So, well, this gets to, Chris, I should ask before I move on, is that list sound right to you?
Yeah, I've been beating the zoning drum on this podcast
Ryan, do you
for
have
a
a
long
view on
time.
this? Do you want to push back at all?
No, zoning's
Ryan's
okay.
kind of a gadfly. He'll take the other side of most anything, but I don't know about this one.
No, I agree. Zoning is a big problem. Buildable lots is another one.
Which
if you look
one?
around,
Yeah.
the availability of finding buildable lots.
Yeah.
Land development.
Exactly. I mean, if you look in South Jersey, you think of beach towns where they knock down old homes to build new ones. Now they're doing it in suburban Philadelphia. They're going into neighborhoods, buying houses, knocking them down and building new ones.
Yeah, I would put it more broadly than just zoning. It's clearly zoning. It's the permitting process. It's
Permitting. Yeah.
and the sewers and everything
yeah.
you need to do to
Sure.
get the shovel into the ground. The estimates of both the time cost and monetary cost to get a shovel into the ground is just, if anything, technology should have made that faster, all sorts of ways, and it hasn't. I mean, even going back quickly to the mortgage market, it's still not any cheaper to originate a mortgage, and yet we have better technology. And someone needs to step back and sort of, wonder why we haven't harnessed the technology to make these things less costly.
Yeah, good point. Good point. So this takes us to policy and, what should policymakers be doing? So I've got two specific policy questions for you. The first is around the housing policy in President Biden's Build Back Better legislation. Yeah. What do you think of that legislation? I mean, it is focused on the supply side of the market. How do you think about it?
Well, I in some sense, it's a catch-up. It's really not that bold. It's absolutely needed, but it's sort of a catch-up if we had sort of normal policy all along. I think of that as whether it's public housing that had, when I was there, the estimate was we were short of $50 billion of capital improvements in our public housing. 2 million of our most vulnerable households absolutely needed. It shouldn't even be a question. You have to maintain, that type of housing and infrastructure. It's also housing vouchers. And again, people have, done this, very important. And I think the Build Back Better creates like 2 to 300,000 additional vouchers. But we haven't expanded, even though our population's expanded from when it was 200 million to 330 million, we haven't increased the number of vouchers. Only 1 in 5 people who are eligible for those vouchers can actually get them. This would be, a very modest step in closing that. I mean, people throw around big numbers, but these are 10-year numbers, right? The estimate of really to close that gap would be about 50 billion a year. It goes back to, where do we want to spend money? I go often back to FDR's 1944 State of the Union address. We were still, in the middle of a war. My father was still in Italy in the Air Force at the time. And yet, he said, now's the time to start planning for the future. And he basically outlined that, decent housing should be an economic right. And in many ways, the Biden administration's, picking up that mantle and trying to, advance it. But the really modest numbers in terms of the needs, whether it's public housing, whether it's vouchers, down payment assistance is important, some of the construction of affordable housing through housing trust and low-income housing tax credits. In some sense, we're just scaling it back to where we were in 1970.
Yeah. Yeah. I mean, I think when President Biden proposed his Build Back Better agenda, soon after he got elected, there was about $500 billion over 10 years for housing related initiatives.
Yeah.
And of course, that got scaled down because the size of the package has been scaled down.
Yeah.
And now it's at $150 billion over 10 years. So you're right. You divide 150 by 10, you get, I don't know, 15 billion per annum in a $23 trillion economy. That doesn't take you very far.
Yeah.
But it's moving you down the path in the right direction, I suppose, generally speaking, but because it is a large part of it is focused on affordable rental supply.
Yeah.
But how far is it going to take you, with that kind of funding? That makes a lot of sense. I did have 2 other quick policy questions. The other one is around and this is a little bit more in the weeds for I think some of our listeners, but I think important and clearly in in the middle of your strike zone, and that works. I know that metaphor works for you because there you go. Yeah, tell me, where's that baseball coming from? Is that, you said, it's 1983 World Series?
1983 World Series.
Okay,
It was the Phillies against the Baltimore Orioles. Cal Ripken's only World Series ring came from that year.
Oh.
And the Phillies still had Tony Perez. If I'm a big Reds fan, as you know, so no longer had Pete Rose, but they had Tony Perez still on that team.
You're a Nats fan now, aren't you?
Yeah.
Yeah, hard not to be because they won. When was it? A year or two ago? 3 years ago.
3 years ago. Yeah.
2 or 3 years ago now. Of course, Ryan is like a shameless Red Sox fan. I know that. I find that highly irritating. What about you, Ed? That feels.
Well, I'm at MIT, so I did get to Fenway Park this year.
Yeah, you got to remember. Yeah.
Yeah. So it's if I have to root for an American League team, I'll go with the Red Sox.
It's hard not to root for the Red Sox.
Yeah.
But it's a great stadium too, as you know.
It is. It definitely is. Yeah, I used to go there when my uncle lived there, and when I was a kid, I'd go in the bleachers there with the wall. Yeah.
But at least the Boston Braves won the World Series.
They won the World Series.
Boston Braves.
Boston Braves. Yeah. Right. So in talking about in the strike zone, FHA, at least on paper, is doing pretty well, and from a financial perspective. The insurance fund that backstops the FHA is, according to the actuary, pretty fulsome. I think it's 8% kind of.
Yeah, 8% of the mortgage balance is outstanding. 6% of that is already in the bank, if you will. There's already receipts that Treasury has gotten. and 2% sort of that 30-year net present value calculation. So it's doing
Yeah.
quite well.
It, not to go in the weeds, but it, that's kind of a capital kind of, that's the sort of there to back. If you have losses, then in theory, this money would be set, if this was set up like a private institution.
But
I
it's
guess
not
the
a
net present
private.
value isn't quite right. It's not exactly.
Well, I mean, there's no backstop. It's a government program, just like Social Security.
All right.
It has the eagle on it. It's full faith and credit. The insurance is good on the Ginnie Mae securities. So really that 6% that's already in the bank is the amount. This was conceived as a mutual type of mortgage product. That 6%, can also be thought of as how much has been overcharged given the actual path of the economy. Now, we could have gone down a different path, but we over the last basically 8 years, we've overcharged by about 6%.
Yeah. Yeah, I guess then there will be points in time when you undercharge then too, right? Because if you're in the downside of an economic cycle, you'll lose money. Yeah. So the idea is that you want to keep the treasury kind of whole, so to speak, through the
on
cycle.
average.
On average.
Through the cycle, yeah.
That's kind of the idea.
Yeah,
so
absolutely.
I'm holding, in a good time, I want to build that insurance fund so I can draw that down in the bad time.
Well, yes and no. I mean, why not? Or you can just, why not let it fluctuate and just price what you think the average over the cycle is? The government doesn't need the money. You're basically pre-funding, you're pre-funding taxes for bad times. And it's the same as a tax.
Yeah.
Mathematically, it's absolutely the same as raising taxes on middle-class homeowners.
Yeah, I'm just to be clear, I'm not arguing this is the right way to, run the railroad. I'm just saying that's kind of sort of the idea behind it. It's not a great way of running the railroad. It's kind of sort of the idea.
I'm going to push back just a little because obviously, in many ways, as you get a lower number, if you're the head of FHA, you get called in front of Congress and you get yelled at more. So really what we're doing now, if you go back into the sort of what I call the physical space, we're charging homeowners, and most of them first-time home buyers, many of them communities of color, we're charging them more now so that in 5 years, the head of FHA is less likely to get yelled at as much by Congress.
Okay.
It seems like that's a silly thing to do.
The political economy of it makes it particularly silly. Yeah.
Yeah, I mean, it's you should charge what you think the long-term cost is. That is the vision of the program. It's a mutual program. In the old days, we would have rebated that 6%, back to the actual homeowner because it was a rebate program. That as as your vintage paid down, if it collected more than it paid out, you would get a refund check. They've stopped that many years ago. But.
Okay, so with this conversation as a backdrop to the question, it sounds like right now the FHA is charging a premium, that's that's embedded in the rate that's charged the borrower for this, to set this money aside for the fund. It feels like what you're arguing is we shouldn't be doing that. We should cut the insurance premium at this point because it's set too high.
Yeah.
It's and therefore should be lower.
Absolutely. I mean, there's some discussions of how it should be targeted and the like upfront versus the overtime premium. Should low balance loans or low income borrowers get a bigger break than others? So there's some policy questions that need to be discussed, but in aggregate, there's no reason to be charging as much as they do.
Let me ask you this question though. In the current context, with the lack of housing supply and given house prices are rising very quickly, a cut in the insurance premium is like effectively cutting the rate. It is cutting the rate. Mm-hmm. So that's going to increase demand even more,
right.
Bump up against that lack of supply and jack up price. So are you really helping anybody by cutting the premium?
Well, you're helping you're helping the people who have the cheaper mortgages. I actually was asked this question the other day. might you want to make policy to try to slow down house price appreciation? You should consider it. If you had a list of 20 things to do, and I'll go back to Ryan and Chris's list, is why are you doing quantitative easing? Basically, that would probably be number 1 on my list. Number 20 on my list would be the FHA premium. But why not start, if we want to have this discussion, and we should, and this is what FSOC and the like was, intended for, the state, the Dodd-Frank Financial Stability Oversight Committee Board, whatever. You would go down that list and see which levers you would want, to do. Changing FHA policy might be the 20th on the list, and it has the biggest impact on low-income communities of color. You wouldn't start there. So that's one observation. 2 is by the time you actually get around to it, the dynamic, some of this is really 2-3 years out. We announce the price decrease for 2 years out, if that's what you're worried about. But I would not start. I understand the point, and it's a legitimate point, but it should be a big part of a bigger discussion of should we do things, whether it's LTV restrictions as other countries do, whether it's ending quantitative easing, whether it's the tax policy of deductibility. There's a host of questions. I wouldn't start with FHA.
Yeah.
My 2 cents.
I guess I wouldn't, just to push back a little bit, I don't think I'd argue that I would use FHA as a counter-cyclical tool. I wouldn't. You're right. I mean, I wouldn't think
in some sense that's what people are arguing for when they say don't do it.
No, but I don't know that it helps anybody, because if you buy into what I'm, the logic of what I'm saying, rates go down, house prices go up, so the net payment for the borrower is still the same. They're not getting anywhere with that. They're not
FHA is only 13% of the mortgage market. So, so you're distributing, even if it's dollar for dollar in aggregate, gets capitalized. The people who get the lower rate are doing better than the people who don't get the lower rate.
Okay.
Fair
enough. Yeah, fair enough.
You have better models and can do the math, and
I
always like your insights, but my gut says you're still helping those people net.
I just wish there was a way to take that money and help build more homes.
Well, we should.
That's like, please, can't we figure that one out? Yeah.
Well, maybe it's interesting. FHA, about a quarter of FHA is for new construction. Maybe we should lower it.
Yeah.
This is the type of discussion we should have. Maybe we should target it towards promoting affordable building, and instead of 25 basis points across the board, maybe if you're doing a $150,000, $250,000 new construction, you get a full point off.
I like that. Maybe we should. I'm going to send you an email. Let's talk about that, because maybe we can write something on that topic. That would be.
Yeah. You can target where you put the money.
Where you cut the insurance premium. Hey, I did want to also, final thing, because I've kept you very long. We've kept you too long. On homelessness, I know you've been thinking about this pretty deeply, and obviously this is all tied up with all the things we were just talking about. This seems like a really big deal. It's a big problem in many communities already, but it just feels like it's going to get worse before it gets better. Or am I just?
Yeah, well, it's always been a problem. We made some significant impact of trying to end homelessness, especially among veterans in some cities. There's no doubt, as rents go up, homelessness goes up on that. And, again, Build Back Better was trying to, make sure that the most vulnerable people got additional vouchers. So, that is of concern. Those are the people who get hit the hardest when rents are increasing. And then the other thing, that I think is, important that we should reiterate is, I always remind folks, these are our fellow citizens, sometimes, very much down on their luck, but we need to provide services for them. It almost goes to some of the zoning things that Chris talked about. We need to make sure that there are decent outhouses, restrooms, showers, bathing facilities for these communities. In some sense, until you completely get rid of it through a more robust voucher system, I do think you have to worry about providing services. You can walk around any town, especially compared to Europe. It's very hard to find a restroom when you're walking around. So I do think it's important that there's a certain human dignity on how we treat people who are homeless for a variety of reasons, and not to stigmatize them on that. It's important to think of the housing ladder. And to think whether it's homelessness, senior housing is another, big issue. Housing for people who have disabilities. It's a big country out there, and it's not just that home ownership margin that you and I have spent a lot of our careers focusing on. You have to think of the entire housing ladder out there, and I think homelessness, needs additional resources. Build Back Better is focused a little bit on that, and it definitely is something we need to focus on.
Yep, housing as a right. I think that makes.
That's what Roosevelt said, and I really encourage people to look at that 1944
I didn't know that.
economic rights. He calls it the Second Bill of Rights on that, and he has sort of a great quote that says, no matter how rich we are, we need to look whether it's the 1/3, 1/4, or 1/10 of the most vulnerable. That's how we sort of should measure our progress, not on GDP. It's a great speech.
That is. I'm gonna have to go take a look at that. Well, what a great man. Well, thank you, Ed. I really appreciate you taking the time and giving us your wisdom. Much appreciated. And hope we can have you back. I'd love to have that conversation around climate change at some point.
Yeah.
It sounds like a really interesting.
Be glad to. We can hope
you.
One day to do it in person in Philadelphia.
Oh, and we go see a game, right?
And
I'd
we
like
can
to
go
go-
see
I'd
the
like to
game.
go see a game.
Yeah, absolutely.
Good. Well, thanks. Oh, guys, have you noticed I haven't touted
Yeah, I was
my
going to say,
Twitter
you forgot,
handle
I thought we were going to make it all the
Oh,
way through without
yeah,
it.
No,
But here it
No.
comes.
at Mark Zandy. Hey, Ed, are you on Twitter?
I am not.
Okay.
I have at times been on Twitter for the Golub Center and when I was at FHA,
Yeah.
but not personally, not on Twitter.
I've just gotten active in the last month or so. So I got my Twitter handle 10 years ago, never used it. And since we had this podcast and, everyone was saying I'm acting old and I got to get, caught up on social media, and there's no way I'm getting on Facebook or Instagram. I thought, okay, I'll try the
I'm waiting for TikTok.
Well, you have to hashtag. You have to hashtag Pete Rose when you Twitter on this one.
Okay.
I want to know what your vast readership or thinks whether Pete Rose should be in the Hall of Fame. It's the most burning question out there.
I didn't realize that was still a question. People are still debating that one, huh?
That's still debate. Yeah.
Okay. That's
You can.
What do you think? What is your view on that topic? Should
I
it be?
grew up in Cincinnati.
Oh, yes, of course.
He was an all-star in 5 positions. It's not a character reference. It's a baseball reference. Yeah, it's a baseball. There
What
are
do you think,
others
Ryan?
out there too that need to be in the Hall of Fame. But
What do you think, Ryan? You on board with this?
Yeah, eventually if Barry Bonds, Kurt Schilling, they all get in, and that was like the steroid era. Pete Rose should be in the Hall of Fame.
Yeah, you're right.
mean-
Good point. Yeah, good point. All right, Ed. Thanks a lot. Hey, happy holidays.
Happy
and
holidays.
Take care. Stay safe, and I hope to shake your hand soon. Take care now.